All right. It is Tuesday, December 23rd, 2025. We are digging into the pre-market institutional notes to really decode this short-term battlefield.
And that battlefield is defined by, well, extreme caution, married to a kind of opportunistic readiness.
So our mission this morning is pretty surgical. We have to cut through all the noise of this holiday week and figure out exactly where you, the active trader, need to focus.
It's all about getting inside that mindset. For you, trying to navigate this, the sources are screaming one thing. The market is on a genuine tightrope walk.
A tightrope walk.
Absolutely. So our task is to synthesize the technical lines in the sand and those crucial macro drivers. We're talking yield, the DXY, to see if we're setting up for a Santa Claus rally or if, cracks are already emerging for Q1 2026.
Okay, let's unpack this right now, starting with the immediate sentiment from that overnight session. The mood is, well, it's decidedly neutral, almost hesitant. S&P 500 contracts are flat, just treading water. Nasdaq futures are ticking down, maybe a little profit-taking, down 0.1%. Dow's up a marginal 0.05%.
This isn't conviction. This is pure indecision, and it's wrapped in some very thin volume.
It really is the definition of waiting for a signal.
And we certainly didn't get one overnight from the global catalysts. What we're digesting right now is some very mixed global manufacturing PMI data. It points to a really uneven recovery picture.
Okay, let's stop there for a second. We throw around acronyms a lot. For anyone new to this, what does mixed PMI actually signal about global health, and why is it so important right now?
So PMI, the Purchasing Managers Index, is just a health check for the manufacturing sector. Anything over 50 is expansion, below is contraction. The problem is the data is mixed.
Meaning
You might see surprising strength in one region, which signals good demand, but it's immediately offset by, a disappointing contraction somewhere else.
so there's no synchronicity.
Exactly.
Yeah.
And that means risk appetite stays constrained because the global economy isn't firing on all cylinders. It creates a lot of hesitance.
And the central bank chatter isn't helping the inflation picture either, which is usually what breaks a rally's back.
No, not at all. We saw some cautious, very pointed commentary from a European central bank official about persistent, stubborn inflation.
Right.
So even if the Fed is on hold here, those global inflation fears, they temper any kind of massive risk-on appetite. If the ECB is worried, you feel the ripple effects on capital flows instantly.
So if the macro and the central banks are keeping the implied open stuck in this tight range, that means we have to look past the indices. We need to see where the institutional money is actually moving.
We have to spot the flow.
Yeah.
And the clearest signals for that always come from pre-market volume and those big price changes. They're proxies for sector sentiment.
And this is where it gets really interesting. Let's look at the standouts. On the bull side, we've got Quantum Innovations, QAI. It's up a solid 3.2% pre-market on high volume.
And the catalyst is reports of a significant AI infrastructure contract win.
So what does that actually mean beyond just one stock?
So what here is much deeper than one company's balance sheet. This suggests we're shifting into the second phase of the AI trade. Phase one was all noise and narrative, right? Retail buying the promise. This second phase, which QAI is signaling, is about accelerating enterprise AI adoption.
So real money being spent.
Real money. Big multi-year contracts to build out hardware and data centers. If the market is rewarding these infrastructure wins, it confirms that the enterprise spending thesis is intact. That gives you broad sector tailwinds, even when the index itself is quiet.
That distinction is vital. Narrative versus infrastructure, AI. But the bears are having their say too. Global Logistics Corp, GLC, is slumping 2.8% pre-market.
And this one is driven by an analyst downgrade. They're citing softening e-commerce demand combined with rising fuel costs.
That's a double whammy.
It's a true canary in the coal mine moment. You've got a key logistics player getting hit by both softer demand and higher input costs at the same time.
Which points to bigger problems.
It highlights potential weaknesses in global consumer spending heading into the new year. So GLC's dip is a warning that the consumer's resilience might finally be starting to falter.
Beyond those two, we've filtered the early action. We've got three other tickers with high relative volume and clear news. Let's start with Quantum Leap Innovations, QLI.
Right, QLI. There are rumors circulating about a breakthrough in quantum computing. It's driving about 5 times its average relative volume. This is, highly speculative interest.
And that kind of speculation means the levels are extra important. What's the battleground for QLI today?
For QLI, the bulls need a definitive break and hold above $125. If they manage that, the target is $132.
And the downside?
But because it's rumor-driven, If that early interest fades and it falls below $118, watch out. That's where profit-taking will accelerate and your support drops all the way down to near $112. It's a high-risk, high-reward chart.
Got it. Next up, Green Energy Solutions, GES. They announced a massive new government contract. This feels more certain than a rumor.
It is. For GES, they need to hold conviction above $55. That shows the market is buying into the contract scale, with a target right at $58.
And if it fades?
If those early gains disappear and it drops below $53, that Claus concerns about maybe execution risk or competitive pressures are overshadowing the good news.
Okay, and finally, a big gap up in Global Pharma Dynamics, GPD. Unexpected FDA fast-track approval.
And that's a very strong foundational catalyst. For GPD, the bull case requires maintaining that $210 level after the gap up. If it holds, $225 is the immediate target.
And the red flag.
If the gap fails and it drops below 205 pleggers, that's a big red flag. It could signal unexpected questions are surfacing about the drug, or maybe competitors about to make a move.
The rule here is so clear. High relative volume, 4 times average or more, paired with real news, that gives you a roadmap for potential gap-and-go trades.
Precisely. It tells you where the institutional focus is. Now let's shift back to the indices, because they are stuck awaiting a catalyst. We need to define the battlefield with clear lines in the sand.
Let's start with the S&P 500 futures, the ES. Where does the trend truly break?
Well, the big picture is just tight consolidation since late November. We're coiling. For support, the immediate floor is 68.51 to 68.55. That was Monday's pivot. A breach there signals near-term weakness.
But where is the major defense, the point where the buyers really have to show up or capitulate?
That is the key defensive line, 6765 to 6778. This zone is critical. If we break decisively below 6765, that signals a significant trend shift. It confirms sellers are in control, and it exposes levels down towards
6,600. That's the most critical number to watch on the downside.
That's it.
But hold on, you define 6765 as that key defensive line, but volume has been so thin this week. Couldn't the number just be, a statistical anomaly, easily breached by a low-volume flash move that doesn't really signal a trend change?
That's a crucial counterpoint. And yes, low volume makes price action more susceptible to sharp moves. But 6765 isn't arbitrary. It represents a statistically significant pivot from the last 2 consolidation cycles.
So even on low volume, a break matters.
It matters. A breach there would force algorithmic selling and momentum traders to reassess risk. So while the signal might be quicker than usual, the result, a major trend shift, is still confirmed.
Understood. Now let's look at the ceiling. What do the buyers need to prove?
The immediate ceiling is 690.273, Monday's high. Clearing that validates buyer intent. But the real overhead supply is up at 699.36 to 699.57.
Strong statistical barriers there.
Very strong. If we get a decisive push and sustained trade above that zone, then we are legitimately targeting the 52-week high around 70.14.
Okay, shifting to the Nasdaq futures, the NQ, the technical suggests it shows more immediate downside risk right now. Why is that?
It's facing those renewed concerns over AI funding valuations. It's just been faltering since late October, and its chart looks weaker than the S&P's.
So what's the floor there?
The immediate floor is 24,700 to 24,800. Buyers absolutely must defend that zone to avoid quick downside momentum.
And the line that defines a deeper corrective move for tech?
That would be the key defensive line at 24,500. A loss of that level signals a much deeper corrective move is underway. If that breaks, we're looking at substantial further downside.
And on the resistance side for the Nasdaq?
The immediate ceiling is 24,918, but the true overhead supply, the big one, is much higher, up at 25,900. Clearing that would be the strong bullish signal aiming for the highs around 26,300.
So the clear verdict from all these levels is consolidation, just waiting for a breakout or a breakdown. And you wanted to clarify why this is not a liquidity trap. People misuse that term.
Yes, absolutely. The distinction is key. A liquidity trap is an economic term for policy ineffectiveness, usually with near zero rates. What we're seeing is simply range-bound price action.
It's indecision.
It's pure indecision. Buyers and sellers are perfectly balanced, waiting for a real catalyst, which usually needs high volume to resolve this coil. It's about price action, not policy failure.
That clarity helps. Now let's broaden the view to the core macro drivers that could be that catalyst. The 10-year yield and the dollar index, the DXY.
These two are major headwinds, especially for tech, which has driven most of the returns this year. If the 10-year yield spikes today, it's generally negative for tech.
Okay, Give us the simple explanation for why a spiking yield hurts a growth tech stock so much more than, say, a bank, the discount rate impact.
It really is pure math and time. Tech companies get their valuation from earnings projected 5, 10 years out. The yield, the risk-free rate, is the discount rate you use to bring those future earnings back to today's value.
Right.
So when the 10-year yield spikes, that discount rate goes up, and it severely erodes the present value of those far-off profits. A promise of $100 in 5 years is worth a lot less today if you can get a guaranteed 5% now versus, only 1% before.
That makes it very clear. Now let's bring the dollar index, the DXY, into it. We know tech giants rely heavily on international revenue. Infotech leads the S&P with something like 56% international exposure. How does a stronger dollar pressure them?
It acts like a silent currency conversion tax, an FX loss. If a U.S. tech company sells €1 billion worth of software in Europe, and the dollar strengthens by 5% before they convert those euros back.
To get fewer dollars on the books.
Exactly. That €1 billion suddenly converts to maybe only $950 million. It immediately pressures reported profits, even if sales volume was strong. If the DXY breaks higher, that pressure mounts instantly on those big mega-cap names.
So if these yields and the DXY start spiking, what is the pain trade for the average retail investor?
The pain trade is that violent, sudden rotation out of long-duration growth and speculative tech and into value sectors like financials or industrials.
And why is it called pain?
It's pain because retail often chases past performance. They're heavily allocated to the high-flying growth stocks that did so well in the low-rate environment.
It's a classic psychological trap, isn't it? As traders, we always want the confirmation that the last successful trade will work again.
Exactly. But the market rarely grants that wish when the fundamentals shift. A sudden yield spike forces an immediate valuation reevaluation. It catches those investors off guard and exposes companies that were valued more on narrative than on free cash flow.
So you have to adapt.
You have to adapt or get left behind. The focus has to shift to quality, to cash flow, to reasonable valuations, not just the promise of tomorrow.
So what does this all mean for these last few trading days? The S&P is delicately balanced with the key defensive line at 6765. The Nasdaq, though, points toward more downside risk, governed by that 24,500 line.
And the direction of the 10-year and the DXY holds the ultimate key to which way this coil unwinds.
So what's the final takeaway?
The takeaway is volume. The market is coiling, but you need high volume to confirm a breakout or a breakdown. So here's the thought for you to mull over. What does the absence of truly decisive, overwhelming pre-market volume, even with those gappers we talked about, tell you about the institutional appetite for risk right now? Is it extreme, disciplined caution? Or is everyone just already on vacation, waiting for January? That collective indecision is the most important factor to weigh as you approach the open today.